Welcome to the Tax and Retirement Institute's video on how to eliminate future taxes with the COVID-19 CARES Act tax law. Yes, folks, it's time to divorce Uncle Sam before taxes rise. Have you ever stopped to think, how tax efficient am I? You have income taxes and you should be lowering them every chance you get. You have tax on your Social Security income potentially, which needs to be lowered. You have an estate tax when you die. They want to tax you there, and you can do some proper tax planning to get the money outside of your estate. There's a lot of different ways to lower your tax, and it's your duty as an American to lower your tax. It's a right for your family. So let's look at one of the ways on how we can do that. Do you or your clients or your friends or your relatives or your loved ones own tax-deferred qualified accounts? Qualified plans, if you work for a corporation, are 401ks, profit sharing, pensions, and ESOPs. If you're self-employed, they look like IRAs, simple IRAs, SEP IRAs, and KEOs. And if you work for the government, it might be a 403b or a 457 or a pension plan. All of these plans pay tax on the way out. So please, please, please pay close attention. If you don't follow our strategy, you will experience severe tax consequences. We guarantee it. Our new Alpha Roth Financial Science uncovered a major hurdle to successful retirement. Qualified retirement accounts pay income tax when you withdraw your money in the distribution phase of retirement. But did you know these accounts can produce hundreds of thousands, even millions of dollars in future taxes? And the problem escalates when taxes rise. Qualified accounts are actually a partnership with the IRS in the form of tax deferral. You put your money in, you get a little tax deduction, you grow it tax deferred all the way through retirement, and then you have to pull your money out and you get taxed on it with a future tax rate that's completely undetermined. Why not eliminate that risk from your portfolio and become tax efficient? Now, this is a chart on the top earning income taxpayers in America. Right now, that's if you earn $500,000 or more, you will be paying the top tax bracket of 37% currently. And as you can see, taxes are near all-time lows. They've come down dramatically from the 70s down to around 1990, 93, and they're back up a little bit, but they are near all-time lows. So the simple question is, do you think taxes will rise from an $8 trillion COVID-19 bailout? The U.S. government has already made $150 trillion in unfunded promises. Folks, taxes are rising. Let's go over a quick case study example for a 50-year-old with a $100,000 IRA, averaging an average 7.5% annually, with a 24% effective income tax rate, and the heirs will be taxed at 37%, and we're not going to include any estate taxes in this example. This gentleman will pay over $600,000 in taxes. Now, how could that possibly be? The account's only worth $100,000. Well, let's find out. The big taxes are actually from compounding interest over years of time that Einstein called the eighth wonder of the world. So we want you to request your future tax liability illustration This is a brief example of one. So here we have a gentleman starting off at 100,000 at age 50. At age 51, he has 107,500. We fast forward to age 70, and he has 424,000. And at age 72, he has $490,892, and the government says he must take required minimum distributions, RMDs. And now you can take them at age 72. It used to be age 70. They changed the law this year. So now he must withdraw 3.66% of the $490,000 balance and withdraw $17,981 from his account, pay tax of 24%, and pay $4,300 in tax for that year. Now, if we continue to grow his account at 7.5% and pay tax along the way, we can see that that's a lot of taxes, and they continue to go up as the required minimum distribution goes up, the percentage rate. And so now this gentleman has paid $143,000 during his lifetime. And here we assume he passes away at age 90, and he has $675,000 left for the heirs. Well, now let's see what happens to the heirs tax situation. This person's daughter inherited $675,000 at age 65. She can no longer stretch the IRA over her lifetime, but she does not have to take any RMDs for 10 years. So she lets the account grow at 7.5%, and she compounds the money, not taking any money out, and she has left $1.295 million. But she must cash out the account in the 10th year by law. It was the new Secure Act tax law passed this year. So that puts her in the top tax bracket of 37%. Keep in mind, 10, 20, 40 years from now, the tax rate could be much, much higher. But let's just assume today's tax rate at 37%. That gives her a $479,000 tax that she'll have to pay. So, the IRA tax paid during the life of this individual was $143,000. His daughter paid $479,000 for a total tax liability of $623,000 on a $100,000 IRA. Dramatic, isn't it? This is completely avoidable with Alpha Roth planning. So let's see which strategy is best for you. We can keep your taxable IRA and do nothing, do no planning, and pay $623,000 in tax or more when taxes rise. We can convert today at lowest tax rates in history and pay $24,000 in tax, or we can utilize our Alpha Roth strategy and pay potentially $0 in tax. You decide what's best for you. So now that you understand the problem with qualified accounts, let's fix the problem. We've written a book. It took us years of research, and we've called it the Alpha Roth Tax-Free Strategies book. It minimizes tax on Roth IRA conversions, qualified distributions, Social Security income, rental income, and much, much more. This book is a quick read, written in layman's terms, and you can get a free copy of it by registering for it on our website. So what is alpha? Alpha is a financial measure of a profit above a benchmark average. In this case, a traditional Roth conversion would be $24,000. If we can lower the tax rate upon conversion, then we've created alpha for you on the Roth conversion. So let us create alpha with your Roth IRA conversion. So Alpha Roth stands for Retirement Opportunity Tax-Free Hedge. Hedging future taxes is just plain smart in this tax environment. The Roth IRA is undoubtedly a great gift to American taxpayers. Roth IRAs grow tax-free and distribute income tax-free. But paying the conversion tax has been painful until now. Alpha Roth can reduce Roth IRA conversion taxes by up to 100%. We combine several proven tax reduction strategies to lower Roth conversion taxes to zero. And the best part is we do all the work for you. Now let's look at how Alpha Roth, coupled with the new CARES Act tax law, can really reduce Roth IRA conversion costs. For starters, the new CARES Act language on early withdrawals from retirement accounts is absolutely remarkable, and you have to take advantage of it. Let's go over the CARES Act notable points briefly. So let's review some of the simple CARES Act qualifications to see if you can even use this strategy. First, you or your spouse had COVID-19. Your business temporarily closed. You were furloughed, laid off, or work hours reduced. Well, didn't President Trump force everyone to stay home and not go out? So therefore, practically everyone qualifies. So the first important point you need to understand is you can withdraw up to $100,000 from your 401k, 403b, IRA, and other accounts with no 10% penalty prior to age 59 and a half. This is wonderful, and we're going to show you how to utilize this to your benefit. Number two, there is no mandatory 20% federal income tax withholding requirements on distributions, so they don't withhold your money. Number three, distributions can be taxed as income spread evenly over tax years 2020, 2021, and 2022, and I'll explain in detail what that means. Number four, and the Grand Slam home run beauty, you can contribute your $100,000 back to a qualified plan within 3 years with no penalty. And we can legally put the money back into a new Roth IRA that grows tax-free, and you can take the money out tax-free. If you ever wanted some extra cash for a house down payment or credit card payoffs, now is the time to take advantage of this loophole before it expires at the end of the year, because you'll never be able to get at this money again without the 10% penalty and the 20% withholding. Let's review a quick case study on how Alpha Roth tax-free retirement strategies coupled with the new CARES Act can really do some amazing things from now to the end of the year. Here we have a client with a 401k and 403b, and they decide to withdraw $100,000 out using the CARES Act distribution, and they're going to spread the tax out over 3 years, paying only $8,000 a year for 3 years, as opposed to paying $24,000 this year, which would be the traditional method. Now, if we compare that to the $623,000 of tax due with no planning, the choice is quite clear on what to do. But wait, it gets even better. Do you want some money to help pay the tax? We've got you covered. Here we take your $100,000 and we put it into an investment that has a first year investment credit bonus of 15%. So yes, there are investments that will actually pay you money up front and credit your account $15,000 to help pay and cover the tax. And these investments are protected where you cannot lose a penny and still can outpace equity-like returns. So we want you to consider these types of investments whenever possible. Now, the total tax to convert was $24,000. We've just given you $15,000 to offset that tax. So now you're only paying tax out of your pocket over 3 years of $9,000 as opposed to $623,000 by not planning. This works on larger account balances too. So if you have lots of money, over $1 million in pensions and IRAs and SEPs, you definitely want to review this strategy in detail. You can request your complimentary tax-free plan and we'll go over it via video conference because we are COVID-19 conscious. Now we do want you to have a real sense of urgency, and that is because tax rates are near all-time lows and tax rates can change at any time. Mr. Joe Biden has announced that he will immediately day one lower taxes if he gets into office. Now the presidential race is up for grabs, so why not just do the planning ahead of time, and it doesn't matter who wins, you have prepared yourself to eliminate future taxes, which will again eliminate future tax rate worries from your life and create substantial tax savings. Our Alpha Roth tax-free plan is clean, simple, legal, and audit proof. Do not procrastinate. This opportunity is due to end December 31st of 2020, just months away. Please act quickly. Please schedule a call with our think tank team today by clicking the schedule introduction meeting button on our website. Or if you just can't wait, we understand, call 607-829-7384 and get your questions answered right now. John Edward Oxendine is a Harvard MBA and chairman of the board of the Tax and Retirement Institute. We are a think tank of seasoned professionals working together to solve financial problems. We offer comprehensive planning strategies in the fields of investments, annuities, and real estate, retirement planning, tax planning reduction, long-term care coverage, and estate and asset protection. Receive your complimentary tax-free plan today.